Welcome to part 4 of our in-depth exploration of the Dhandho Investor by Mohnish Pabrai. In this final segment of our series, we'll bring together the key concepts we've covered so far and dive deeper into how you can build and manage a portfolio that reflects the Dhandho philosophy. This part is all about implementation, turning knowledge into action to achieve lasting financial success. Let's start with the Dhandho portfolio construction. According to Pabrai, the essence of building a Dhandho portfolio is simplicity and focus. You don't need to own dozens of stocks spread across industries you barely understand. Instead, aim for 6 to 10 carefully selected investments, businesses you know intimately with deep moats and purchased at a significant discount to intrinsic value. The idea is to make fewer but smarter bets, each one chosen for its low-risk, high-reward potential. Pabrai emphasizes that concentration is your friend. He points out that Warren Buffett made the bulk of his wealth from a handful of outstanding investments. Pabrai's view is that if you find an opportunity where the odds are massively in your favor, where you're buying $1 for 50 cents, it makes sense to allocate significant capital to that idea. Too many investors dilute their returns by spreading their capital thinly over mediocre ideas to feel safe through diversification. The Dhandho way is about intelligent concentration rather than mindless diversification. Next, let's revisit the power of asymmetric bets. Pabrai repeatedly reminds us that the hallmark of a Dhandho investment is a situation where your downside is limited, but your upside is substantial. Think of these as bets where if things go wrong, you lose little, but if they go right, you gain significantly. This could be buying into distressed businesses with hidden value, investing in temporarily hated sectors, or seizing opportunities where market psychology has created unjustified fear. This is where cloning comes into play again. Pabrai strongly encourages investors to study the moves of great investors, those who have proven track records of success over decades. By understanding what they buy, when they buy it, and most importantly, why they buy it, you can shortcut much of the trial and error that comes with independent analysis. Cloning isn't about blind copying. It's about learning how great minds think and applying those lessons thoughtfully to your own portfolio. Another core Dhandho principle is focus on the long term. Pabrai urges investors to think in decades, not months. The stock market can stay irrational longer than you think, but if you've bought a wonderful business at a wonderful price, time is your ally. The value will eventually shine through. Pabrai advises against frequent trading and market timing. Instead, once you've identified an undervalued business with a strong moat, buy and hold until the price reflects the value, or until the moat erodes, at which point you reassess. Mistake management is also a big theme in Part 4. Pabrai candidly shares that mistakes are inevitable in investing. Even the best investors in history have made significant errors. The Dhandho approach mitigates this by focusing on businesses with a margin of safety. When you buy at a significant discount, even if your thesis isn't perfect, the low price provides a cushion. More importantly, Pabrai advocates learning from mistakes, reviewing each investment decision to see what worked, what didn't, and why. Now let's talk about temperament, the often overlooked key to success. Pabrai stresses that your emotional discipline is what sets you apart. Markets will test your patience. Prices will fluctuate wildly at times, and fear or greed will tempt you to act impulsively. The Dhandho investor remains calm, rational, and focused on intrinsic value rather than market noise. Your greatest edge isn't analytical brilliance, it's emotional stability. Finally, Pabrai wraps up the book by reminding us that the Dhandho framework isn't about complexity. It's about applying a common-sense approach consistently over time. Low risk, high uncertainty. Heads I win, tails I don't lose much. It's about stacking the odds in your favor, staying within your circle of competence, cloning wisely, and letting the power of compounding do its magic over decades. To summarize Part 4, build a focused portfolio of your best ideas, not a scattered collection of mediocre bets. Make asymmetric bets where the downside is small and the upside is large. Clone the best ideas from great investors, but always understand the reasoning. Think long-term. Ignore short-term market noise and let value shine through over time. Learn from mistakes and manage them through margin of safety. Master your emotions. Temperament is often your greatest advantage. And above all, keep it simple. The best strategies are often the simplest and the hardest to stick to. Thank you for following this series on the Dhandho Investor. If you've enjoyed this content and want to continue learning powerful investing frameworks that can transform your financial future, make sure to like this video, subscribe to the channel, and check out our full playlist on value investing classics.